Today, markets are still impressed by several surprises from major central banks that arrived last week. The unexpected policy decisions confused the forecast for future actions of the central banks over Europe and the United States to reduce interest rates. The Federal Reserve may be able to maintain its aggressive monetary policy even longer than other advanced economies. After the unexpected move by the Swiss National Bank last week, a June rate cut in the eurozone and England already looks realistic, especially in the light of statements by ECB President Christine Lagarde about the prospects for taming inflation and decisions at the Bank of England. Although the UK regulator has not yet changed its interest rates, two of its most hawkish policymakers softened their stance and joined the ranks of those. Besides, one of the ECB hawks on Friday announced the chances of the first rate cut in April. Last week, on March 20, the Federal Reserve also maintained interest rates unchanged, but comments from Fed Chairman Jerome Powell were seen as dovish and led to a fall in the US dollar. On the other hand, a series of robust economic data has since raised doubts that the central bank is actually going to cut interest rates 3 times this year. It's not a surefire scenario that the US Fed will launch monetary easing in June. Moreover, this week, reports on the PCE price index for February, which is the Fed's preferred indicator of inflation, are published. Any increase in these indicators will destroy hopes for a Fed's rate cut in June. In the meantime, the prospects for a rate cut this year, confirmed by the Fed chairman, have inspired Wall Street. Last week was the best week for stocks in the last 3 months. The S&P 500 closed it with a gain of 2.3%. The barometer of the stock market's health started trading on a Monday quietly, consolidating within the intraday corridor between 5,216 and 5,224 points. Forex traders also prefer to refrain from buying for now, after a 1% rally against its basket of currencies last week. The US dollar is trading more modestly today. The dollar index is trading lower within the intraday corridor between 104.10 and 104.50. However, experts do not rule out the possibility for the greenback to break through the upper border of and move towards the 105 level. The fact is that today the monetary authorities in China and Japan have become strong deterrents for the US dollar. A new decline in the yen, so it's a multi-year loss, forced Japan's financial authorities to warn markets about their readiness for currency intervention on forex. So the yen may weaken to 151 against the US dollar. Also, according to market experts, China's state-owned banks carried out a large injection of liquidity into the domestic market by selling dollars, but Jin is trying to support the yuan amid low interest rates from the People's Bank of China. However, it's unclear whether a dollar sell-off on a Monday means that authorities are striving to defend the yuan's forex rate at around 7.2 or are simply trying to stem its decline. At the same time, traders went long on the US dollar because the Federal Reserve seems to be in no hurry to cut interest rates compared to some of its peers. Therefore, the euro found itself among the outsiders of the dollar basket of currencies. But on a Monday, for the above reasons, the pressure of the American currency on partners was disrupted unevenly, so the euro managed to slow down its downward cycle around the level of 1.0800. Then the euro began to grow, moving in the channel of 1.0800 to 1.0840. Perhaps the reversal of the euro-dollar pair today can also be explained by a profit taken. In any case, the scale of the dollar's advance and the catalyst for its growth are so significant that the euro's growth looks very fragile and can only be explained by the temporary weakness of the American peer. Hence, the instrument is likely to correct below the level of 1.08 at the end of the day. Interestingly, oil, which had simply been consolidating in a narrow range of 85.40 to 85.90 since last week, also began to grow in the second half of the day. At the same time, the Brent price even left its established corridor of $85 and $86 per barrel. Last week, crude oil also showed a modest rally. Then there was a technical pullback by about 3%, and today the Brent price has almost returned to the levels of March 21 at around $86 and $60 per barrel. The main supporting factor continues to be oil and fuel reserves in the United States. If they continue to decline further, then crude oil will receive an extra incentive to grow. Tomorrow's data from the American Petroleum Institute will clear up the picture. The bearish scenario for Brent crude is possible under the condition that the price must fall below $85. In this case, a stronger pullback in the direction of the support area of $84 and $83 per barrel is in the cards. You have watched the market review by InstaForex analyst for Monday, March 25. Subscribe to InstaForex TV channel and we keep you updated on all market developments. Feel free to ask any questions and leave your comments. So see you online tomorrow.